Good afternoon and welcome to the Creston Reeves Budget Webinar. This webinar will be hosted by Clive Ralph, who is our private client tax partner at Creston Reeves, and Miranda Wood, our tax manager. This webinar will last around half an hour and will be followed by a Q&A session. All attendee phones will be muted throughout the webinar. However, you can ask questions through the pop-up on your screen. This may appear as a small red arrow on the top right of your screen. If you expand this, you will have the functionality to ask all questions. All questions will be answered at the end of the webinar. Should we run out of time, then your questions will be answered via email after the webinar. A recording of this webinar will be sent later in the week. I will now hand you over to Clive.
Thank you, Steph, and welcome everyone to our 2018 budget webinar, the last budget before we Brexit. We hosted a budget breakfast event earlier today with a French magician, as you do, which hopefully explains the theming of our slides. Our webinar today will highlight what we saw as the most relevant parts of yesterday's announcements and the Chancellor's 80-minute speech. These today are supplemented by two handouts, our 2019-20 tax card and our 2018 budget summary, a more detailed commentary on what was said and what wasn't said yesterday. You should see these on the right-hand side of your screen. You can access them now, or if you wish later, we will be emailing you a copy of the presentation where they will be embedded. Now, Monday was, of course, an odd day for a budget. Normally, Wednesday is the Chancellor's preferred date, and most concluded the change was to avoid a clash with Halloween and the inevitable headlines this would generate, like this, for example. So here's our agenda. I will obviously mention that Miranda is going to cover the business tax changes, and I will cover personal tax after that. We're going to then review what the morning papers said and what they made of the Chancellor's budget. Our handouts I've mentioned already. I mentioned this was the final budget before Brexit, and at our 2016 budget breakfast 3 years ago, a few months before the referendum, 2.5 years ago, we ran a poll with our guests, and this was the result. This was replicating the question that was asked in June 2016. We thought it would be interesting to run it again this morning to see whether the 65% majority in favour of remaining had changed. This was the result this morning. Surprisingly, fewer people voted to remain in the EU as compared to the poll in March 2016. Brexit is such a complex topic, I don't honestly know what to make of the result, but there it is. So let's consider what the Chancellor said. Most pundits expected higher taxes to fund the £20 billion promise to the NHS made by Theresa May a few weeks ago, but no one was really expecting him to be prepared to borrow more. He talked yesterday about a new path for public spending to help the strivers, grafters and carers in our society. He told us that the past 8 years of austerity had been driven by necessity, not by ideology, and that this budget would pave the way to a brighter future. All this was remarkably upbeat for a party without a parliamentary majority and continued struggles with Brexit and internal matters. The tax increases that were projected by many but didn't happen. There was no uplift in either income tax or national insurance rates. The VAT threshold predicted by many to be slashed didn't change, and in fact it was fixed at £85,000 per annum until April 2022. There was no further curtailment of the tax benefits afforded to those providing for their pension, as predicted by many, and capital gains tax entrepreneurs relief was left largely unscathed, but there were a couple of detailed changes we'll come to in a moment. Some things which did happen then. We were told that austerity was finally coming to an end. We were told that the purse strings would be relaxed, with the Chancellor commenting that limited new borrowing was okay after all, a surprise for many. He told us proudly that 3.3 million new jobs had been created since 2010, with a further 800,000 coming by 2023. And he told us also about a tax cut for 32 million taxpayers, which has been accelerated to April next year rather than April 2020, of which more later. So looking at the detail, let's consider the business tax changes and I'll hand over to my colleague Miranda Wood.
Thank you, Clive. The budget saw limited changes from a business tax point of view, probably more tweaks than actual changes themselves. We'll first look at corporation tax, and the budget has seen the rates of corporation tax remain unchanged. We've currently got a corporation tax rate of 19% at the present time, and it is planned that this will reduce further to 17% with effect from the 1st of April 2020. Corporation tax rates have reduced significantly in recent years, from 28% in 2010-11, with an expected rate of 17% in 2021. This, in real terms, means a tax saving for a company with taxable profits of £500,000, reducing from a £140,000 tax bill in 2010-11 to just an £85,000 tax bill in 2021, a tax saving of £55,000. Government are clearly looking to encourage businesses to increase their investment. Changes have been announced with regards to annual investment allowance, and this is set to increase from £200,000 currently to £1 million for 2 years with effect from the 1st of January 2019. Therefore, it is advised that any significant spending should potentially be delayed until after this date to maximise the relief available. Furthermore, potential timing of spending could be considered in connection to the reduction in corporation tax rates. A saving of tax at 19% would be more favourable than the reduced rate of 17%. Spending of £1 million while the tax rate is still at 19% could see a further tax saving of £20,000 in comparison. The change in the annual investment allowance will be time apportioned for those businesses whose year end does not fall in line with the end of the calendar year. So, for those companies with the December year end, the application of the increased rate will be relatively simple. However, for those companies with a year end other than 31st of December, there will need to be an apportionment of the rates before and after the change. This will apply to both the increase in rate on the 1st of January 2019 and the decrease in rate with effect from the 1st of January 2021. So, what does this look like? To give an illustration, a company who has a year end of the 31st of March 2019 will need to time apportion the allowances of £200,000 and £1 million. As you will see, the overall annual investment allowance available for the year ended 31st of March 2019 would be £400,000. However, the total amount claimable in the period 1st of April 2018 to 31st of December 2018 would be a maximum of £200,000, this being the total amount claimable for the entire year if it weren't for the increase in the rate. The additional expenditure would need to be post 1st of January 2019 to benefit from the additional allowance. The year ended 31st of March 2020 would qualify for the full £1 million relief, with a further restriction than the year ended 31st of March 2021. Therefore, as previously advised, careful consideration should be given to the timing of expenditure. A little bit more on capital allowances. With effect from 1st of April 2019 for companies and 6th of April 2019 for unincorporated businesses, there will be a reduction of 2% on the special rate pool from 8% to 6%. The special rate expenditure pool includes expenditure on long life assets, thermal insulation, integral features, and expenditure incurred on or after the 1st of April 2018 on cars with CO2 emissions of more than 110 grams per kilometre. Therefore, the time it takes to obtain relief on the expenditure on these types of assets is being prolonged. Some of you may remember the old industrial buildings allowance regime. The government have announced with immediate effect a new relief for expenditure on commercial buildings and structures has been introduced. This will see a relief of 2% on a straight line basis on the building itself, which builds on the integral features which have been claimable in the special rate pool for a number of years. There will be no balance in allowances or charges on the disposal of the property. And again, whilst this relief is new, it is not dissimilar to what we have seen previously, known as industrial buildings allowance, which was abolished in April 2011. And this will be a welcome tax saving to those looking to invest in new property for their business. We've seen in recent years the government's push to encourage green technology. They are still further increasing their encouragement for businesses to invest in green technology with an extension to their 100% first-year allowances. The 100% allowance on the provision of electric charging points was due to end in April 2019. This has now been extended to the 31st of March 2023 for limited companies and 5th of April 2023 for unincorporated businesses. The measure is designed to complement the 100% first-year allowance for expenditure on cars with low carbon dioxide emissions. It should be noted that this was reduced from 75 grams per kilometre to below 50 grams per kilometre with effect from 1st of April 2018, and that these enhanced capital allowances on cars will end on the 1st of April 2021. Cars with CO2 emissions between 50 grams per kilometre and 110 grams per kilometre are eligible for capital allowances in the general pool with a writing down allowance of 18%. You should be aware, however, that these favourable allowances on the provision of energy efficient cars is due to end 2 years before the provision of the energy efficient allowances on the actual charging points themselves. In addition, the favourable first-year allowance on energy-saving plant and machinery will be abolished with effect from the 1st of April 2020, so this seems to send out mixed messages with regards to a green future. We're still seeing encouragement for small and medium-sized businesses who are currently profit-making to be able to claim relief for research and development expenditure of up to 230%. Loss-making SMEs can claim a repayable credit of 14.5% on the lower of the loss arising in the year or 230% of the qualifying R&D expenditure. An SME for research and development purposes is a company with less than 500 employees, turnover of less than €100 million and a balance sheet value of under €86 million. With effect from the 1st of April 2020, the amount of research and development tax credits a loss-making SME company can claim will be restricted to 3 times the company's total PAYE and NIC liability for that tax year. Any loss that cannot be surrendered for a payable credit can be carried forward and used against future profits. The SME scheme is much more favourable than that for large companies, whom are only entitled to claim 12% of their qualifying R&D expenditure as additional relief. There was a focus on our high streets and town centres being crucial to our local communities and economies, and the acknowledgement that our buying habits have created more challenging environments for these local businesses. It was announced yesterday that with effect from the 1st of April 2019, a reduction of 1/3 in business rates for retail properties will come into force over the following 2 years for properties with rateable values below £51,000. This could benefit up to 90% of all retail businesses in our high streets and see a saving of up to £8,000 per annum. Few employment-related issues arising from yesterday: an increase to the national living wage from £7.83 to £8.21 with effect from April 2019. The £3,000 employment allowance is to continue, but will be restricted to those businesses where the employer's NIC liability is less than £100,000 in the previous tax year. This would equate to a wages bill of £724,000. This measure will come into effect from April 2020. The apprenticeship levy, which was introduced in April 2017 and continues to apply to large employers, will pay bills who pay bills in excess of £3 million. The levy is 0.5% of the pay bill. However, it has also been announced that the amount of the co-funded contribution the employer has to contribute has been cut in half from 10% to 5%. It is not yet clear when this reduction will take place. Off-payroll working. The net is closing. April 2000 saw the introduction of the IR35 legislation. This is a set of rules which were introduced to stop individuals providing services to an end user operating through a limited company and as such avoiding payroll taxes. These individuals would be an employee if the contract with a limited company were removed. The old emphasis was on the individual to decide on their status, and this has now shifted to the end user whose contracts the individual and their company for their services. In recent years, we have seen reform in the public sector with regards to IR35, where the emphasis has shifted to the contracting party being responsible for deciding whether their contractors are caught by these rules and whether they should be taxing them on the payroll as employees. These changes will now also apply to the private sector in the same way. Changes will be introduced with effect from April 2020 and will apply to large and medium-sized businesses only. After consultation, it was felt that it would not be practical for all businesses to apply these rules, and as such, small businesses are currently exempt. Digital Services Tax was a new tax that was introduced yesterday, and with effect from April 2020, the government have announced that a new Digital Services Tax will be introduced to target the large tech giants. For some time now, various countries from around the world have been trying to agree a fair system for taxing the huge revenues that are being generated by the Googles and Amazons of the online marketplace. The UK government has taken the lead in this area with the introduction of the Digital Services Tax. This is a 2% tax charge that will be levied on revenue from certain digital businesses that derive their income from UK online services such as the provision of search engines, social media platforms and online marketplaces. This will apply to businesses whose global revenues exceed £500 million. There will be an exemption for loss-making entities. It should be noted that this is not intended to be a tax on the end user as an online sales tax. And it also comes with the caveat that the directive may change if the OECD introduce a worldwide policy. Finally, we have seen several delays by HMRC in the introduction of Making Tax Digital. The aim of MTD is to make tax compliance simpler and more efficient by providing digital records. It will see the introduction of quarterly digital reporting. The introduction of digital taxation will begin in April 2019. The first businesses subject to this new regime will be those who are VAT registered and whose turnover exceeds £85,000. It has been suggested that up to 880,000 of UK VAT registered businesses are unprepared for the changes which will come into force in less than 6 months' time. If you haven't already thought about this, it is time to start thinking. In summary, a lot of the changes we have seen in this budget are tweaks and refinements to what we already have. Corporation tax remain unchanged. Investment relief greatly improved over the next 2 years. Can you take advantage of the favourable green allowances while we still have them? Or could you make use of the 5-fold increase in the annual investment allowance? The planning of the timing of your business expenditure is therefore crucial. Reduction in the special rate pool for capital allowances. However, the introduction of a 2% allowance on structures and buildings. We've seen additional relief for retailers on business rates, but will this be enough to allow our businesses to carry on? And finally, you should review any contracts that you have with personal service companies. Would they be employees if it were not for their limited company? And MTD, is your business ready for April 2019 and beyond? I'll now pass you back to Clive.
Thanks, Miranda. So for those who like these sort of things, I can tell you that the 8th of November is the date when the Finance Bill will be published. At the moment, we're working on press releases and other announcements from the Exchequer, but the Finance Bill comes out on the 8th of November, which will have all the detailed provisions. So I'm going to cover personal tax, and these are the main areas I'm going to touch on in the next 15 minutes. Nuts and bolts will cover the changes to tax allowances and exemptions. Entrepreneurs relief, I mentioned some while ago, there were some changes which caught the eye, relevant to all running businesses. There were a few more restrictions to make it less attractive for third-party ownership of houses, in other words, landlords. Taxation of dividends, a quick reminder on how the rules work. We'll touch in on inheritance tax, just to see what, not much, but what's changed over the past year. Pensions likewise, contributing to your savings nest egg, and then have a quick look at savings and what happened with ISAs. And at the end, our Hey Presto will leave you with a few takeaways from yesterday's personal tax changes. So before the budget, there was speculation that the Chancellor would perhaps freeze the amount of tax-free income we could all receive annually, and or rein back on his earlier promise that by April 2020, it would only be income in excess of £50,000 each year that would catch higher rates of tax. Such a move could have saved the Exchequer £2 billion, some 10% of what he needed, what the Chancellor needed to honour his leader's promise to the NHS. As it was, Mr Hammond confounded everybody yesterday by not only sticking to his earlier pledge, but by accelerating it by a full 12 months. The upshot is, the right-hand column on this grid, is that come April 2019, an individual can receive £12,500 of income free of tax, with the next £37,500 chargeable at the basic rate of 20% only. So it's only anything over £50,000 that becomes liable to higher rates. It's not shown on this slide, but income between £50,000 and £150,000 will be taxed at 40%, with a 45% rate for income in excess of £150,000. As in prior years, the tax-free allowance, that's £12,500 next year, will be gradually removed for those whose income exceeds £100,000 and totally removed for those with income in excess of £125,000 from April next year. Also changing next year, lower down the slide, is the exempt amount of capital gains we can each realise in a tax year, going up from £11,700 to £12,000. Otherwise, subject to a few matters we're just about to cover, there was little to say about capital gains tax within this budget. So, entrepreneurs' relief. One of the matters that did change is a highly valuable relief available to those running a business, be it a sole trader, a partnership, or through a limited company. As shown on an earlier slide, most people, capital gains tax is assessed at 20%, or 28% for gains arising on residential property sales. However, a gain arising on the disposal of a qualifying business asset can be taxed at a rate of 10% only, at least on gains up to £10 million, which is more than enough for most people, thanks to a relief called entrepreneurs' relief. The two main changes announced yesterday both make it less easy to qualify for this valuable relief. The first change, effective April next year, is that to qualify for ER, the asset in question must be held for a minimum of 24 months rather than the current minimum of 12 months. Not necessarily a disaster for most, but this could trip up those unfamiliar with the changes, and forward planning will be more important. The second change, effective from yesterday, only impacts those holding shares within a limited company, so not sole traders or partnerships. Current rules say that to qualify for ER on a shareholding, the disposal must hold a minimum of 5% of the company's issued share capital, giving them at least 5% of the voting rights. For disposals made today and later, however, this rule is tightened, with shareholders now needing to be entitled to at least 5% of the distributable profits and net assets of the company, in addition to the other tests. Whilst this might sound of limited relevance, in our experience, the mischief will most often arise within companies which have a number of different classes of shares, giving voting and economic rights. In preparing our presentation yesterday evening, we quickly identified two of our clients where such provisions would now jeopardise entitlement to entrepreneurs' relief. Potentially, such a problem might be remedied with the introduction of an enterprise management incentive scheme, as we wouldn't expect the new provisions to impact on such arrangements. But the takeaway here is that if you are holding shares in a private company, you need to check as to what the arrangements are under the bonnet. Another area impacting capital gains tax announced yesterday will affect those with more than one residential property. These changes add to a number of earlier attempts by the Chancellor to dampen down people's enthusiasm to invest in additional residential properties, being a 3% stamp duty surcharge in 2016 and the removal of tax relief for interest costs associated with borrowing for buy-to-let properties, which was introduced in 2017 and is gradually being phased in. There were two changes yesterday, both effective April 2020, so in 17 months' time, which will further restrict an individual's ability to secure tax-free capital gains on the disposal of a property which at some stage they occupied as their main home or principal private residence. The first change halves what's known as the final period exemption from 18 months to 9 months, which in many cases will result in additional tax being paid on a gain arising from the disposal of the property concerned. Most commonly, we are talking here about an individual who owns 2 or more properties, each of which at some stage has been used as their main home. The change will reduce the amount of CGT exemption available in situations where 2 properties are held and the exemptions might be running in parallel. The takeaway here is that for those in a multi-property situation, it will be necessary to keep a closer look at ownership dates to maximise the availability of tax-free gains. The second change impacts those who will be selling a property in which they have lived for at least a proportion of their ownership period, with this property also being let out to third parties. Typically, this would qualify you for something called lettings relief, and typically the letting would be under a short hold tenancy. Current rules provide for a time apportionment of any gain arising on the sale of such a property between the period when the property was physically occupied as the main home and the period when it was let, with the former expected to be tax exempt and the latter taxable. So for someone owning a property for 5 years in which they lived for 2.5 years and rented for 2.5 years, the simple analysis would see 50% of any gain being liable to tax and 50% exempt. But in addition, because the property was your main home at some stage and it was let, you qualify at the moment for something called lettings relief, which could give you a further £40,000 of gain entirely free of tax, or £80,000 if you own the property jointly with another person. HMRC have determined that this relief is not working as intended and proposed to tighten the rules governing eligibility to this relief, such that from April 2020, unless you co-occupy the property with your tenant, you won't qualify. Now, in our experience, most people let their second property wholly and aren't living with the tenant, perhaps not surprisingly. So it'll be a major sea change come April 2020 for those who are anxious to retain their entitlement to lettings relief. Inheritance tax didn't change much. It's worth noting that the residence nil rate band will rise from £125,000 to £150,000 down the bottom of that slide in April 2019. The basic exemption of £325,000 remains unchanged, as does the rate of tax. That said, the entitlement to the residence nil rate band, which is in addition to the standard exemption, is not a given, and in our experience, many failed to qualify due to a lack of understanding of how this relief works. As you can see here, the additional exemption, which is intended to cover where your property or home passes down a generation, is only available where the deceased leaves their home to a close descendant, so a son, granddaughter, etc. is fine, but not any more distant relatives, or where the property is left to a trust, which can catch many people out, where they have what's called a discretionary will trust, a discretionary trust will. So the relief is complex, and it is not to be taken for granted. Interestingly, I saw a survey the other day that Guildford is now recognised as the IHT capital of the UK, as in 2016, with more residents paying inheritance tax than any other location in the country, with an average liability of £231,000 each. Little change with pensions as well. The tax-free fund you can take out from your pot when you access your benefits remains at 25% of the value of the fund. Tax relief continues to be available at the marginal rate of income tax for those contributing money into their pot, which was contrary to what a lot of pundits thought was going to happen. And the maximum premium that can be invested with tax relief claimed, also that £40,000 limit, lesser figure for high net worth individuals, that wasn't changed either. So in practice, nothing happened with pensions yesterday other than a modest increase, an inflationary increase to the sum you can hold tax-free in your pension fund, increasing from £1 million to £1.055 million. Individual savings accounts, probably we all know what they are. There's little to say about ISAs either. The government scheme to encourage us to save by providing income tax and CGT exemptions on funds within such arrangements. In brief, the annual ceiling for individual investment remains unchanged at £20,000 per annum, which for some investors, those aged between 18 and 14, could include up to £4,000 within what's known as a lifetime ISA, which attracts a valuable contribution in addition from the Exchequer, particularly useful for those looking to save to buy their first home. So the slide has the relevant details. Turning now to excise duty and beer and such like, for the 9th year, duty on fuel was frozen, and for most beer and cider, the duty was also frozen until at least April 2020, with an uplift of 2% on top of inflation for tobacco products, which adds 33 pence to a packet of 20 cigarettes. Returning to the topic of first-time buyers, you might recall that last year a new exemption was introduced to aid first-time buyers who were acquiring properties at a cost of under £500,000. In such situations, the first £300,000 of purchase price could be exempt from stamp duty land tax, which would save up to £5,000. At that time, that exemption was not, however, extended to what are known as shared ownership arrangements, typically perhaps through a housing association, because the point there being that it's only if all the names on the title deeds of first-time buyers is the exemption available, and with a shared ownership arrangement, there are two names on the deeds, one of which would be the other party to the arrangement who wouldn't be a first-time buyer. So the relief, stamp duty land tax relief for those situations was extended as from yesterday for those in shared ownership and backdated to November 2017. So if you know of anybody who was a first-time buyer who entered into any property transaction since November 2017 and paid stamp duty land tax, there's a distinct possibility that the liability might be refundable because of the change that took place yesterday. So our takeaways then from yesterday's budget, there's this potentially generous uplift in personal allowances and tax bands, which is estimated to benefit up to 32 million people. Most basic rate taxpayers will be £130 better off, with larger savings for higher rate taxpayers. And of course, these savings will crystallise only 6 days after Brexit, 29th of March, 5th of April, so the timing is undoubtedly political. Entrepreneurs relief needs a review, so you need what's called a real material stake in a company now to qualify for entrepreneurs relief. Well worth checking. There's a further squeeze on landlords with changes to principal private residences, and it's well worth checking your eligibility to the additional residence nil rate band for inheritance tax purposes. So to conclude, we'll take a quick look at what the newspapers made of Mr. Hammond's announcements yesterday, and then should there be any questions, we can address those to conclude. So the Guardian looked upon it as a budget of tax costs, tax cuts and spending to shore up the Prime Minister. The Metro had a rather catching tricks and treats. Fiscal Phil splashes the cash, claiming the era of austerity is over. Income tax boost for millions, more for universal credit. But of course, the other side don't quite see it that way. Budget 18 of the Telegraph, taxpayers handed a Brexit bonus. We talked a few minutes ago about the timing when the tax savings by virtue of the change to allowances will impact people's pay packet, which will be just the week after we Brexit. Chancellor has discovered a magic money tree on planet Tory. The Times refers to it as Hammond's giveaway gamble. It's all predicated on better than expected borrowing figures, but hopefully there won't be tears before bedtime. The Eye refers to Hammond easing up on the big squeeze, income tax cuts that no one was really expected, and further benefits and borrowing. And finally, the Daily Express refers to the tax cuts for 32 million, and finally, the Chancellor announced the end of austerity is nigh with a blockbuster budget. We urged him to splash the cash, and now everyone's a winner. So that concludes our overview of the 2018 budget. I don't think we have any questions. And just to repeat about the copies going to our subscribers, Steph.
Yep, so you all will be sent a copy of the recording along with the attachments and the slides. If you have any questions at all, we will send you an email so you can send those across. But thank you for joining our webinar.
Thank you.
Thank you.